Hope everybody is doing well after the holiday weekend. So I'll just hop into it because I know we have a long call and a lot of different things to cover. And some of these topics may be a little more intricate than what we normally cover. So if there's any questions about any of it, feel free to stop and ask me questions, or our guest speaker as well. So first of all, the topic of the call is the VIX in relationship to the S&P. I see Rob Ross's background is literally one of my slides. Let's start with talking about what the VIX is in general. Don't be confused by this mathematical formula that very few people understand. What the VIX really is a measurement of out-of-the-money puts and calls on the S&P 500. And as a result, it's a pricing of forward 30-day volatility. This is the most simple definition of what that is. And the way it works is there's two types of volatilities, right? The VIX is one type of it, which is implied volatility. It's what's implied by the options market. But there's another type of volatility that may be more intuitive to people, and that is realized volatility, observation, what has actually been there. So the historical volatility is just a mathematical way of measuring the standard deviation of an asset, how far away it moves from the mean, if anybody remembers anything from statistical classes. And the implied volatility, what the market is assuming it, is what the future volatility is expected. And that's what the VIX comes into play. Essentially the pricing of options that are out of the money.
Got it.
So far, so good?
Itay, does a high out of the money price of an option equal a high VIX? Is that what you're saying?
Well, one option will not be the case, but if multiple options have a high price out of the money, that will definitely impact the VIX.
Cool.
So the VIX doesn't do a great job at predicting future volatility. This is quite interesting. So without getting too complicated into what this means, to the right, this is real volatility, which is a 30-day historical standard deviation on the S&P 500. And to the left, this is actually the VIX 30-day volatility. So we can actually see that the correlation between them is almost identical. They're almost perfect images of each other. So the fact you have a high VIX doesn't necessarily mean you're going to have a future 30-day really high volatility. It actually means you just had one. So it's almost akin to, you had a fire in your house and you have very high prices of insurance. That doesn't mean that a month from now you're still going to have a fire in your house.
But you'll buy the insurance for it.
Well, but we go into, well, if you buy the insurance at that time, you may be overpaying for it. But that's a totally different topic of conversation.
Sure.
All right. So the VIX, what people use it for, sometimes they use it to gauge market trends or places of extreme where you can find a bottom in the markets. So you can see there in this example from 2014, market's been in an uptrend, volatility kind of grinds lower, VIX spikes, and when it kind of peaks out, mirror image of the S&P, VIX kind of tailors down and S&P rises. It doesn't always work. I will caution against using this as the only indicator of what you're doing for various reasons. I won't go into that now, but a lot of people use the VIX in this classical form as you're seeing it now. They just put the two together and say, VIX has gone up to this extreme. That's got to mean there's a market bottom. I'm going to buy the S&P. 85 to 90% of the people I ever spoke with about it, this is how they use the VIX and the S&P together. So let's talk about the relationship, the true relationship between the VIX and the S&P 500. The VIX here in blue, starting in 1990, and the one-year correlation coefficient between the VIX and the S&P 500. So here in the 90s, the correlation was actually not that great, between 40 and 60%. But at some point, VIX futures were introduced. I believe it was 2004. And even beforehand, the correlation coefficient between the two has become a lot tighter. And we've seen in recent years that the VIX has been inversely correlated to the S&P 80 to 90% of the time. So that's definitely something to pay attention to. What I do pay attention to is a couple of things. This was, again, the slide you had before. I find that very interesting that as of today, where we were, the VIX levels here to the left, by the way, so S&P levels here at the bottom right, the VIX is at the highest level it's ever been, given the market being at all-time highs. So last time we were around these kind of readings was 1999 period. Actually, it's not, March 2000 here, but all throughout the 1999 period, the VIX was making a lot of very high readings alongside with the market. And today we're having similar readings. This is very different than the periods of all-time highs in 2017 and 2018 when the VIX was sitting between 9 and 10. So it pays attention to pay attention to when correlation actually breaks. So I know a lot of people pay attention to when the VIX spikes and we reach this spike, and is that a climax of the sale? To me, it makes, I like to note when the VIX correlation becomes positive. So this has been going back to the beginning of 2018, all the periods of time where the VIX was rising with the S&P, which basically made the correlation between them go positive. And there's a lot of different reasons of why that can happen. Some of those was associated with why the VIX was so high given all-time highs in the market. So before we get deeper into that, there needs to be some basic understanding of the contango in VIX and VIX futures, which I just wanted to share very quickly. I know some people have varying degrees of understanding of this. So it's important to realize that the VIX is not like a commodity, a hard commodity like crude oil. I'll give you the example of crude oil. So let's say you buy crude oil at today's price at $40 a barrel. The price for 5 months from now may be $50 a barrel, because for every month that you're holding that crude oil, you're paying $2 in rent. That $2 in rent over a 5-month period comes out to $10. So the difference between today and 5 months from now, in that case, will be 2 times 5, will therefore be $10, because the price of the future is factoring in that rent.
And Itay, just for the people who don't understand how oil works, can you explain why there's rent being paid?
Right, because it's a physical commodity that's got to be stored somewhere. So, when you're storing oil, you're leasing some space, and you have to pay some kind of rent. I mean, you unless you own a storage place, but then you still have costs of owning it or something you've paid in the past to own it. There still has to be some kind of storage facility, and a lot of times the contango averages a lot of that storage into it. But the VIX is not like a physical commodity. It doesn't have something physical you can hold on to, but it still nonetheless has futures with varying prices. So the question is, why does that happen? The reason that happens is, and this is something that is very important to understand, most of the time, and I believe most of the time is closer to about 80%, the VIX is going to be trading within this structure representing contango. And the reason is the future is going to be higher than the today price, the spot price, because there's more time for uncertainty to happen. And that's essentially the rent you're paying to be holding a position that can protect you from downside, right? So if you think about it, if you have a future contract that expires in December of this year, in theory, it protects you for whatever volatility can happen in the election period. But if you have a contract that expires next month, it does not protect you for the election. So it, in theory, should have a lower price. And what happens is, if you want to continuously be exposed to the VIX, if you buy at point number 1, after about, let's say 30 days, that contract expires into the spot, you need to then sell it, or it expires, and then you roll it into point number 2. So you essentially harvest the loss that's created from this process. So if the spot VIX was at $18, and the contract was purchased at $20, as it comes to expiration, it results in a 10% loss. So I know this is a tricky thing to kind of understand. So I'm going to pause for a second to see if anybody has any questions about that. Nope, everybody understands.
Actually, Itay, I do. Sorry.
Okay.
So it sounds like, because I've never completely understood this, and I'm an options guy, as to why it always does, in fact, trade at a premium. And I guess what you're saying is it's almost like there's an implied option within the futures contract. So the question I would have, I guess, is while you're right, it's not like crude oil, and there's not a clean ARB because there's not a deliverable to keep it honest, if you will. Is there an ARB in here? Can you in fact sell it at 20 and buy the option, the actual options on the underlying, or at least some representative that would be adequate, and then hedge it, hedge the deltas to some way match that that volatility you bought, and then there'll be some sort of convergence?
I would say this much. I think Alex Green should answer this because he actually trades this junk.
Your turn to shine, Alex. You got to go off mute.
You're throwing me under the bus.
There you go.
No, you can't.
Okay, why?
There is now, Itay, if I say something wrong, let me know. But so you can actually, in theory, do a little bit between the options on VIX, because there are options on VIX, and the futures on VIX. The settlement time is like a day off, so there's an error problem there, but there's no real delta there, right? So it's not like a stock option where you can buy IBM options and then you can delta hedge with IBM. You can't delta hedge with VIX. I guess in theory, maybe you create the VIX with all the options on S&P, but good luck.
Well, that's kind of what I was referring to. If you were to take the biggest 30% of the S&P or whatever it might be, or of whatever the components were, that was the biggest 30%, and in fact buy the options on those underlying stocks, and then sell the VIX. It's almost more, you'd think there'd be some conversion. Now I understand that, again, you're just buying implied volatility, so you then have to hedge it and hedge it properly. And there's a lot of moving parts. I'm just wondering if there's an ARB there of some sort.
So I'm actually I'm going to take my headphones down here for a second because they were getting a little bit noisy. Hold on. Oh, can anybody hear me right now?
Yeah, we can hear you fine.
Oh, smokes. 1 second, some slight tech.
Now we can't hear you.
I apologize.
No,
now we can hear you.
Okay.
You're on, you're off, you're on.
Okay. No, I had a weird static noise, so I put the AirPods back in and back out. So anybody that shorted Apple stock, that's the reason. So I'm actually going to share a trade that I did with the VIX. That was actually the biggest trade I've ever made. So I was going to share it on the call today with an arbitrage that I was able to find. I don't know if you call it pure arbitrage, but it was an opportunity that existed within the market. So you may find that interesting. But I've researched this market extensively, and I found that it's quite difficult to arbitrage that, but you can harvest the contango. But harvesting the contango comes with its own risks of the volatility spike. But if you know how to hedge yourself correctly for the volatility spikes, I think harvesting VIX contango is probably the most profitable trade to have ever existed. Okay, so let's go right into it. So again, why is holding VIX futures not a good long-term hedge? This is just an easy comparison. I mean, from 2005 to 2014 here to the beginning of 2014, just to give you a flat example of a time period. You can see it's almost negative every single year to hold it for a year, to the tune of, sometimes 80% over a 9-year holding period. Just an average period, again, to 2020 is no different. Average daily loss of 0.19%. So if you start with 100 and you continue to roll it, that contango, and this has 08 included in the period, right? 08 is just this thing. You would essentially go to zero. it will be a 99.9% loss.
And Itay, that's because you said, what, 80% of the time this is in contango?
That's right.
Okay.
And that contango is a powerful force. So the issue with holding this long term is exactly that. So I wanted to talk about that trade actually right now, which derives this trade actually comes from that contango that takes place. So at some point, I think it was 2012, 2011, a lot of these VIX ETFs started showing up. You have VXX, then you had XIV, then you had SVXY. So a lot of retail investors had the opportunity to come into the volatility trade for the first time, having them never done a trade like that before and not fully understanding what that is. So what became really interesting is that inverse ETFs showed up. You had the ProShare version as VIXY, and then you had the Credit Suisse version, which was XIV. And those became really popular. And what were they doing? The fund manager for those ETFs was essentially harvesting the contango trade by selling short VIX futures. But it was done in a fund that was essentially long, because you buy into this fund. You're not doing that yourself. So in this period, going back to this chart, in the period of 2017, 2018, the S&P was making all-time highs, and the VIX was very, very low, trading around the 10 area. One of the reasons for this was everybody was piling so much money into the VIX short trade. So we can see we had that volatility spike in 2015, the yuan devaluation event, VIX over time compressed, and you can see what happens to this SVXY. It goes on a tear from 2016. It was, and this adjusted for reverse splits. So 2015, it goes from 50 and it goes all the way here to 550. So somewhere around at the beginning of 2017, I was thinking about this and I realized, is there an arbitrage here to be made actually? And I was realizing that, the problem with inverse volatility ETFs is that if we have a VIX of 9, which we got to 9-10 area, in theory, we can go up to 18 to 20 in one day. And if they're short VIX futures and the VIX futures get anywhere near that, there's going to be a massive problem, because if you own a long fund, you can't lose more than 100%. But if you're shorting those VIX futures, you can lose well more than 100% in one day. So I realized that what's the protection for Credit Suisse and ProShares from this happening? And I read the prospectus over 100 pages, look, and I didn't see any protection. And I just realized that, if they lose 75 or 80% of their assets in a day, they're going to shut down. So I realized that, I think, early in 2017, and this was clearly very, very early in the trade. As you've seen, it's gone from being stupid irrational to really stupid irrational. And what I started doing is buying far out of the money puts on SVXY, because XIV didn't have options, SVXY did. And I was going 50% out of the money on the put side consistently. So what was the arbitrage, to your point, Larry, was that I realized that at 9, there's a hard floor in the VIX itself. Why is there a hard floor? Because I figured that on the most simple standard deviation for, the way market makers look at it, you have to price options with some amount of volatility. And 9 was more or less the bare minimum in which option business would transact. So what I was doing, I was selling puts on VIX itself at around the 9 level strike price, even though the premium wasn't much, it was 10 or 20 cents. But I was taking all that premium to buy the SVXY puts. So using that system, I was able to roll that trade over the entirety of the year without actually losing money. So that was continuously running with about 0.5% of the fund's money. Then come February 5th, 2018, and SVXY essentially lost 99% of its value. Trading was halted, and that trade resulted in a complete jackpot. Up, I think it was up 44% or something like that for the whole fund, with a very, very small allocation, and literally it's made millions of dollars. So that's the best trade I've ever been able to pull off.
Did you see SVXY and XIV and all that stuff the day that thing was going? They did not move. They're down like 5%, and you're looking at it going, there's something wrong. They're worthless. And of course, you made money.
So that morning I wake up and I come into to the office and I look at my screen and all that, and I realize what's going on, and there's no trading in the option at all and no trading in anything. I had to wait, I think, an hour and a half, 2 hours until these things went back in, but there was no trading on the option at all. So because it's an American style option for the first time, I think the option was, I bought it for maybe 30 cents or 25 cents. It was worth close to $70. And I exercised the entire option, got the right to sell, and then sold it and then bought back the short at the open market. That was the first time I ever did that. First and last.
Unbelievable.
So,
And then what Itay forgot to tell everybody is that day he also made a hole in one at putt-putt. It was just a great all-around day for him. Got a free snow cone, made millions of dollars. It just rounded everything out.
I mean, literally, this is one of those things that is, happens once in a lifetime. And I was very fortunate that happened. And, otherwise me and Jeremy would have never gotten together to buy multifamily because, that was the thrust of capital I needed to do that.
And
so,
I can tell you that your role of that into multifamily was great because we just got the value back that we're going to get on our loan. And it is astronomically higher than what we put into the deal.
That's the other benefit of it. So,
yes.
But anyway, going back.
Itay, quick question.
Sure.
Looking at that trade, I don't see the risk rewards, crazy. What was the risk? How would you quantify, what was the worst thing that could happen? Like what's a scenario that could blow up on you?
So that's the thing. I found that's why I pushed this so hard because I didn't feel like there was risk because
I don't see it either.
The risk was the VIX could go to 7.8 below 9, right?
But then I would lose.
But then he'd make it on the other side still.
Then I would lose. Then I would lose $1 in one roll on a premium. But I noticed that on any expiry, that never happened. So every time I would sell the 8 puts all the time, and just do a tiny bit. So that was how I was able to pay for the carry. I know 3 other people that was trying to just buy puts on SVXY, thinking the same thing, and they kept losing money over many months and just got tired of doing it.
Yeah.
So paying for the carry was the best part of the trade. Because again, I was actually wrong for an entire year until this actually happened. Okay, thank you for listening to that. Going back. Yeah, no problem. So going back, and the reason that trade worked so well in that period, and you can see how in 2017 this is just on a tear. Because Contango at that time, I just get an example, October 3rd, 2017, is 12.31%. So, as long as the market doesn't crash, this XIV just makes double-digit returns every single month. That's why everybody was piling into that trade so much. So, the Vix and volatility is a double-edged sword, and that's what everybody needs to realize, because when this situation turns into backwardation, that's when things get really hairy. So talking about this recent melt up of what's been going on, there's been some news outlets has reported SoftBank was behind it, and indeed they were. So going into the 68th page of their presentation, SoftBank says they will employ $555 million, and Masayoshi Son will manage this, 33%, of course. And they will do derivative transaction, etc. That's all it says. Now, if you go into the 13F, I know it's difficult to see, so I'm going to read it to you guys. Amazon, $1 billion call option. Alphabet, $575 million. NVIDIA, Tesla, Netflix, etc. So at some point, SoftBank decided that they got to make up their WeWork losses somewhere else. So they said, what better way than buying a bunch of call options on super volatile tech stocks to prop those up? So they decided to do that going in June, and they're buying all these call options. And the market has significantly changed, which is one of the things that I think is the reasons the VIX have been so high, considering all-time highs. For the first time ever in 2020, and very recently too, based on this Goldman Sachs research, single stock options volume for options are actually bigger than volume for shares. So we've moved from a market where the dog is wagging the tail to the tail is wagging the dog, because we are trading more volume on future bets on prices than prices themselves, which is, to me, it's just crazy. And this huge spike had to do a lot, I believe, with institutions, SoftBank, and later retail investor Robinhood and things like that just jumping on that wagon, and we're seeing this market going up every day.
Do you think because the call premiums went up and then people were just tempted then just to do covered call trading, just to take a traditional sense, buy the stock, sell the option, and provide the liquidity for that because the pricing for the options had gone so out of kilter than normal?
I mean,
and that would have caused more people rushing into the stocks.
Well, I actually think a lot of it has to do with some people were caught short, but the reason they were short, they were buying the call back, but also there was a lot of speculative call buying, because if you actually had, you did have some covered calls, but I think the majority of the move was actually speculative buying. I'll go back into that. This is the craziest thing that I've literally ever seen. So not only the volume has surged, but the options that expire within 2 weeks or less are 75% of the option volume, which to me is absolutely insane. So our entire financial market is basically turned into a momentum red or black casino, which is just totally nuts.
Well, and another thing is normally the options, as they get down to 1 and 2 weeks, that's when the gamma starts going crazy.
That's
which
true.
Then drives more volatility.
That's right. That's right. So it's even driving it even crazy. You're bringing the next point in, and I don't want to get too complex with gamma and all this stuff. But
Itay, I have a question. So for everybody here that's not as technical as you brilliant folks, what is the implications of how this new market acts on, say, like our individual portfolios? Like, what types of things should we be seeing more of, knowing that this is kind of the tail wagging the dog now?
Yeah, so let's get exactly into that. And I think Apple is this great example where you can see the Apple price versus the price of a call option that's far out of the money against Apple. So normally the skew is basically the variance in price between puts and calls. Okay, that's the simple way of thinking about it. Normally puts should be worth more than calls. Why? Very simple. The market goes down faster than it goes up. Pretty easy. That's what's been the case. But the skew in Apple has totally gone out of whack. Why? Because Apple has crashed upwards, has literally crashed upwards, and you can see that in both skew and in the implied volatility. So what does this mean? Why did all this really happen? When you got a bunch of institutions buying billions of dollars worth of call options, and you got people that wrote calls and are buying them back, you're creating you're creating a massive leverage bet, because remember that each contract of an option is basically 100 shares of stock, right? So when you're buying a call, who's the one selling it? Someone has to sell it.
The market maker.
The market maker sells it. That's exactly right. So the market maker is now short a call, or he's basically short a promise of 100 shares. So what does he do? He goes in and he hedges it. How does he hedge it? There are numerous ways of hedging it, but for simplicity purposes, let's say he buys the 100 shares of stock. For simplicity purposes, what does that do to the stock price?
Increase.
Right. And then more people see it, and what do? They buy more calls. And the people that sold calls before have to close their position. So what does this do? The market makers sell more, which means they have to hedge more, which means you get this crazy squeeze loop that has caused these tech stocks to go out of control. And what you're seeing as a result is that the call options become crazy expensive, which causes VIX to go up even though the market is high. And then what happens is that you're seeing the correlation go out of whack, like we've seen last week, where we saw the VIX going up with the market for a while, which was our hint that, hey, something super weird is going on here. And then the news about SoftBank came out and all the stuff that they did. So what's interesting is that sometime last week, I think it was Wednesday, SoftBank reported that they unwinded most of their positions, and they have been unwinding their positions. Guess what happened immediately after they did? If they unwind their positions and sell out of all that call delta, then the market makers have to buy it. And then the market makers don't need all those hedges anymore. And then what do? They just dump the stock as a result. And everything that went up like crazy is going down like crazy. It's actually quite simple.
Hey, Itay,
Yeah.
this is Brett. Can you hear me?
Yeah, of course.
So I think it might be helpful to point out to them, for those who aren't familiar with the way that the market makers have to hedge, it's helpful to know at a very high level, if someone like SoftBank comes in and purchases, for example, I think the number was roughly $4 billion in total, $4 billion worth of out of the money or far out of the money call options. When the market makers originally take on the other side of that trade, they actually don't have that much exposure. So their immediate hedge is actually going to be quite small. So for example, if someone's buying $4 billion worth of out of money call options, the immediate hedge in the underlying, to say for Apple, for example, the immediate amount of Apple that they would be buying to hedge that is very, very small. But as Apple goes higher, SoftBank also bought $4 billion worth of the underlying itself at the same time, but driving the underlying higher. And it's important to note that as the market goes higher, the market makers then have to come in and hedge to a greater extent, to the extent that if you go into this stratospheric spike in the underlying, whether it's Apple or SPX or NDX or any of those, the actual hedgers would need to come in with hundreds of billions of dollars worth of hedge to hedge against the $4 billion worth of options that were bought. And so the feedback loop is far, far beyond any small number of options bought.
And that goes into what you're going to talk about, convexity, right?
Yeah.
Awesome. So I just have one more slide, which is a little bonus slide here. VIX positioning for the election. I've noticed this interesting bump here. This is one of the weirdest skews I've seen, where you have a lot of volatility in the October contract, which is expected given the election. I believe, what is it, November 3rd? I find it interesting the November is relatively lower. I would expect both of them to be bumped roughly the same, and then volatility is expected to drop after the election. So I'll leave you with that. And
well,
Jared?
if people remember the night of the election last time, the S&P overnight dropped 100 points.
That's right.
Overnight, and then rallied back. So that's what they're gauging for is a repeat of something like that.
Yeah, it was down like 3%, and then you turn around, and then it was up like 3%. But yeah, you got that spike, the October contract, that actually includes, it's the 30 days, that includes the election day, where the November contract is actually post the election day. Thus, that's the thought is why that one's higher than the November.
That makes sense, but it's still quite a big spread. It's three vol points.
It's huge.
It's huge, yeah. 3 vol points.
I would expect now after everything's been crashing than it was prior, like a week or so ago.
On the SoftBank example, is there a reason why, or this is just Mazo-san, like you buy 4 billion worth of options and then go out and buy 4 billion of the same stock?
Only if you're planning on pumping your options prices up.
And then you unwind the option price and still hold on to the stock.
Yes.
That's a good trade.
It's a good trade for SoftBank. They made up their WeWork losses.
And that's when Jeremy educates on deltas, and that will show you how many shares they need to do.
Exactly.
All right.
Exactly. This
is all for me.
Cool. Well, I would say we're going to turn this over to Brett. I just want to give a super quick intro for Brett. Brett, can I speak to your quick intro?
Sure.
All right. Brett is the Chief Investment Officer and Managing Director of Certeza Asset Management. And since the inception of the VIX futures in 2004, Brett's been one of the earliest adopters of trade volatility directly. He knows what he's talking about, and you're really going to enjoy what he has to say. So Brett, it's all yours to take.
Great. One moment, and I'll share my screen real quick.
He also has a not half bad view. So if you ever get by his office, you come in. He keeps Kit Kats and Twix and all types of unhealthy things for you, and they're right there in front of him. We know because we saw it earlier.
That looks an insane office. Oh my God, I'm so jealous, man. Look at that.
Don't fool anyone. I know it's a Zoom background.
We animated the leaves so that they blow a little bit.
Good sci-fi graphics right there.
Yeah. All right, so we'll go through. I'll give you a little bit of a deeper background on myself. Not much because I don't want to get bogged down in that, but when he says that I was involved early on in VIX, so keep in mind that VIX derivatives started trading in 2004, and I had come out of a mathematics background and really found my way into vol trading quite early in my career, and made the transition into VIX trading right when the derivatives came online. So we're talking about days when, you know, the VIX futures were trading a handful of contracts, 5 to 10 to 20 contracts. And at that time, it was myself and a group of vol traders in kind of academia and those of us who'd kind of grouped together were trading them against each other, mostly for bragging rights at the time. And then in 2006, the options on VIX came online and really kind of increased the depth and the consistency of the VIX futures market, where we could actually use mathematics to model it. And so when we talk about this, we'll get into a little bit. One of the questions earlier was, is there an ARB actually available? And I'll kind of explain why there's not, and why there is actually only a stat ARB opportunity available sometimes, as opposed to an actual ARB. So that's my background, and we as a firm now deal mostly in VIX futures, although we are actually launching a mutual fund shortly that deals primarily with convexity in the options world over the S&P 500 rather than in VIX futures directly. So if you have any questions regarding either the use of VIX or the use of options, I'm going to try to focus a little bit more on the concept of convexity in and of itself rather than, you know, the intricacies of VIX or options Greeks or anything like that. 1 second. There we go. So Itay covered a lot of stuff about what VIX is. I want to point out a couple things that you see in this chart here really quick. Notice that we've got actual kind of gray background areas, and then we've got some white background areas in this. And one thing to note about VIX is that it's actually what we call, it has what we call autoregressive conditional heteroscedasticity, if you want to get technical. But what it really means is that volatility clusters. And so we've got periods. If you look here in the 90s, we've got periods of low volatility, and then we've got periods of high volatility that cluster together, and then we go back into periods of low volatility, and these are years at a time. Now, interestingly enough, we didn't randomly pick these gray areas and white areas. There's actually fundamental things about the way that VIX behaves, the way that volatility behaves, and certain underlying macro factors that determine whether or not we're in a high volatility regime or a low volatility regime. And because it's autoregressive, they say, in other words, high vol begets high vol and low vol begets low vol. So a lot of times you'll hear people say average VIX is 18 or something like that. That's actually not a correct or an accurate statement about VIX. There are two primary vol regimes, and VIX has a different mean or a different mode in either of those. So if I was to skip forward in this and say, for example, if you look at the bottom left chart here, you would notice that we've actually gone to the effect in this chart of separating the two vol regimes. And you would notice that the distribution of VIX prices in each vol regime is actually dramatically different. So in a low vol regime, it's a very, very peaky curve, so leptokurtic curve, and most of the time VIX stays in a pretty defined area. Itay mentioned that 9 is effectively the mathematical floor, and really in a low vol regime, VIX doesn't go above, say, a 15 and stay there very much. It just wants to immediately revert back down below 15 again. So it's not to say, for example, that in these, some people ask if this most recent several years was a high or low vol regime because it has quite a bit of noise. By definition, until recently, we were still in a low vol regime. And you would note that by the fact that every time VIX spiked very high, it immediately reverted back down below the 15 mark. And that's where it wanted to be. In a high vol regime, it's very difficult to get VIX to go below 15, and it averages in the low 20s, which is what we're seeing now. So keep in mind that volatility across options and everything in the VIX space, it's very dependent on what regime you're in. And when someone says that VIX is the most mean reverting instrument in the world, you have to know which mean is it reverting to. Is it reverting to this mean right here, that's in the the roughly 20 range, or is it this mean right here that's actually in the 12 range? Because if VIX is at 15, you got to kind of know which one it's pushing toward all the time. Okay, and this is a very, very consistent feedback that we get into within the vol space. So going back up to why would someone actually want to use the VIX in its various forms, or use volatility or convexity in general? Well, there's several reasons. One is that VIX is non-trending, meaning that you don't have to do any fun mathematical tricks or watch out for this trend that you do in, like, for example, the S&P 500. You're looking at it and saying, for example, we know that when it spikes high, it's got extreme mean reversion, so it's going to come back down. It's not a question of if VIX comes back down from 80, it's just a question of how long it takes, and usually it's quite quick. It's single-tailed, so there's a huge benefit to trading an instrument that actually doesn't have two tails, because you don't have to protect against a fat tail in both directions. VIX can go, for example, to 150 and has gone to 150 before. Can't really go below 9. It's structurally inefficient. I'll talk more on that in a moment. It has high convexity, meaning that if you're long volatility at low levels, they will accelerate in their payback for you rather than giving you a linear payback. And they're quite liquid. In fact, they're becoming more and more liquid all the time. So I'll pause there and see, does anyone have any questions before we actually get into why they are structurally inefficient? Okay, so let's address this question of the arbitrage capability of VIX. Why can't you arbitrage VIX in general? You can stat arb it because it is highly mean reverting and it has a lot of statistical virtues to it, but there's no arbitrage because it's the only instrument in the world with a futures structure that actually does not have a physical, and you cannot what we call replicate the synthetic, so you can't recreate the physical. So there is not a cost-efficient way or a cost-effective way to replicate what spot VIX is at any given time. Itay mentioned actually that spot VIX is actually not a very good indicator of S&P 500 direction or anything like that. That's a very true statement. What he didn't say was that VIX futures are actually an incredibly good indicator of S&P direction. So when you realize that S&P futures have good predictive capability, but spot VIX does not, or sorry, VIX futures have good predictability, spot VIX does not, you realize that it's going to be virtually impossible to arbitrage VIX futures against the spot VIX. The reason for that is that when you can't create the physical, there's actually nothing to arb against. And when there's nothing to actually arb against, then the futures can wander in a really, really large range. So if we look at a term structure, much like what Itay showed you, when we're saying, okay, the near month, this is a contango curve that he explained. This is the typical condition of VIX. And you say, for example, is that front month contract that's trading at 15, is that the fair value of that contract? Or the next one at 17, is that the fair value? And the answer for anyone that's actually being honest is, I don't know if that's the fair value. Okay, so it's not like other futures where you can calculate the cost of carry, figure out what the spot price is, and determine what an actual fair value for any holding period is. Itay spoke about the contango curve. One thing to point out that a lot of especially new traders in VIX tend to get wrong is that the future months, for example, the $17 one, the 1875, 1950, those are not predictions of where VIX will be in the future. They're purely a representation of what we call time skew. Or, for example, predicting the weather. You can predict the weather quite well in 2 days. You can predict it pretty well in 10 days, but 3 months or 4 months out is anyone's guess. And so if you're having to, for example, insure something against that, then you're going to require a greater premium for that insurance. So you've got a time skew difference for that. And it's reflected in the options world, and it's reflected in the VIX futures curve. So when I come in and say, what's fair value? Well, look at this heat map a little bit, and you say, this is our proprietary software running in the background and spitting out what might look like a fair value range. So often what you'll see is that rather than this really smooth, logarithmic looking, nice mathematical curve, the curve for VIX futures will look a lot more like this, where it has a lump somewhere and then a dip somewhere. And if you look on this heat map, you would say the darkest areas are actually the most likely to be the correct fair value, and the lighter they get, the less likely it is to be a correct fair value. Now, that's not to say that any of those is not fair value, because we actually don't know what the fair value of a VIX future is. But we can say that if it gets clear out into the light blue colored bands, it's much less probably going to be the correct value. So for example, the really light blue bands might be a 2% likelihood that that's a correct fair value, whereas the dark blue areas might be something like a 75% probability that that's the fair value. And what we also know is that when something wanders wildly outside of its probabilistic fair value, it experiences pressure to move back into the center of that. So for example, that one that's in the middle of the curve that's at 1620, it's going to experience significant upward pressure to get into that dark blue area. Okay, so what kind of things could you do with this? For example, you could buy that one that's at 1620 by itself and look for that upward pressure. But then if the entire curve shifts down, that's going to hurt you. So what you could also do is say that there's a recognition that all VIX futures, for example, are about 96 or 97% correlated to each other. So you could, for example, buy the one that's at 1620 and sell the one that's at 1655, or the one that's at 1640, and anchor them to each other and wait for the relative normalization of the VIX curve. And these are very common trades that we get into all the time, and several others do. So this is why there's actually not an ARB situation available other than what we would refer to as a stat ARB. So statistically, it has a mean reversion push. But other than that, there is no way to actually get a guaranteed ARB in VIX. I want to pause there for a moment and say, does anybody want to interject before we kind of say, how can we trade these things?
Well,
I just had one quick question, and that was on the previous, if you go back to the previous chart, or the one previous, okay, so you have that, and it says hypothetical VIX futures curve, and then the previous one of that is the actual pricing. So you kind of flip between the one you're on and the one previous to that. Okay, then you have the actual price. So I'm showing you a 1620, but then it says 2050. So I'm a little confused on how you would trade it if you're just doing a theoretical price.
Sorry. So what I'm saying is that the reason we say this is a hypothetical curve is because we're just saying we just made these numbers up. We didn't actually pull them off of a real curve, but there are real curves in history that look like this.
Okay.
So the curve might look just like this. In this case, the way that you're using hypothetical is that if we were to draw a solid line connecting through all the dark blue areas over time, that would be actually the hypothetical most likely fair value. Whereas these white dots are, supposedly where the market is currently, the real represented price.
So you all just wait for a stat ARB situation. Once it goes outside of a certain tolerance for mean reversion, then you all are looking at setting a trade.
Yes, and it could be anything from outright long vol to some combination of calendar spread or butterfly spread or ratio spread, anything. We monitor the VIX curve constantly in exhaustion. So the universe of what could happen, really. And
then how early and how late do you monitor it throughout the day? No, you're not trading this at 1 a.m.
No, we trade at any time that we see a dislocation. But for someone managing money like we do, there really isn't enough volume in the after hours for us. We're trading throughout the main trading hours.
So I've got a question here. The example you used before, I'll call it a butterfly. The buy the 20 and sell the wings around it, the 1620 and sell the wings around it. Thinking that it will come more into some type of a linear or at least smoother relationship. Based on what we talked about earlier in Itay's chart, a lot of it is probably or seems to be fundamentally driven, like an election or a big some other big event that's anticipated that does in fact create volatility at a certain number of days. You know, how do you take that into effect? Because otherwise you're really just talking about the stats of smoothness of a curve, I think.
Okay. So it's actually kind of interesting because there are predictable things within VIX. So I'm gonna rip something off of everybody's heard the phrase, we've got the known unknowns and the unknown unknowns, right? We've all heard that. I'm going to introduce you to a different variation of that. In Certeza, we call it the known unknowables. Okay. And the market has a lot of known unknowables. Okay. And by this, I'm not saying that we know that there are unknowable things. I'm saying that the market likes to think it knows something that is not possible to know. Okay. And it does it constantly. So for example, an election likes to price in for, if you go back, if everybody goes back through their voting lifetime and says, everyone right now is saying that this is the most critical election that they've ever been involved in. And if you go back to the last election, everyone at the time was saying it's the most critical election there's ever been. And the one before that was the most critical election there's ever been. And yet, if you go through all of these events that are the most important, highest volatility events ever, you look at actually the way that the realized volatility panned out, and they weren't all that critical. And in fact, a lot of them were non-events. They do the same thing around Fed announcements. And then there's a lot of seasonality. For example, the VIX complex has an incredible amount of seasonality, where there's a huge amount of downward pressure in the holiday season. And then there's upward pressure after that. And then there's a huge amount of downward pressure into June and July. And then there's upward pressure after that. And so it's not just enough to come through and create, for example, the statistician in me would say that the easiest way to determine what a fair value vol curve looks like is just to say, where is the at the money implied volatility right now, and then draw a logarithmic curve from that, because volatility historically exactly matches a logarithmic curve. It's not as simple as that because there are seasonal factors. And so I'll give you a little nugget. If you look back into the further back months, and there's a contract that is somewhat mispriced. So Itay pulled up the VIX Central chart that shows the current curve, and it has a lump on October. Well, if you looked 5 months ago, October had a lump there as well. Those lumps that are generated when a contract first comes into the curve, 6 or 7 or 8 months from expiration, it's highly unlikely that that one is going to anywhere match what the mathematical suggestion would be. In this current circumstance, not only was the October mispriced early on, it's been dramatically increasingly mispriced. Okay, so we look at it and say, well, it appears to be $3 or $3.50 out of whack right now. You would expect it, if I ran an analysis based on the amount of relative strength it had earlier on in its life, it's actually only about $2.25 or $2 out of whack here. But it is still far out on the edges of its probabilistic fair value. Okay, and we're seeing it come back now that the manipulative trades are unwinding in the marketplace. So you look at this and you say, you can buy butterfly spreads, you can do whatever you want, but I would caution anybody that's getting into vol trading to say there are different mechanisms for trading this. And unless you have, for example, what we just talked about is trading along the curve. In the volatility space, if you were to interview 100 different vol traders, we might be the only one or one of two that actually trades along the curve habitually. Most everyone else does some other type of convexity trading or relative value trading. So is there any more question on that, or should I jump to kind of like
how I just want to add to your point that I've noticed that almost every single like expected big event ended up resulting in this big volatility crush, whenever it was Brexit,
yes,
the election, big Fed announcement, whatever it was. If you sold vol into it, you probably made money. I mean, actually, one of the trades I used to do is I had a version of selling volatility around earnings reports for those companies using options. That was like 87% profitable. Same thing. If everybody expects it, it usually is not happening.
Yes. If everyone's pricing it in, it's a known unknowable is what we call it. So that's very consistent. Now, the nice thing about using VIX for this is VIX is pure volatility. So if you went into an event like Brexit, for example, or something like that, and you just sold an at-the-money options straddle, there's still a chance that you can lose on that, even if you're right on the Vega crush, right? But if you sell VIX into it and you're right on the Vega crush, you're going to make money on it. It's not like, oh, I was right on the Vega crush, but the delta killed me, right? Or the gamma killed me. You don't get run over that way. So getting into different ways, how can we use VIX? Well, we just talked about the futures. There's obviously options on VIX. I'll touch on the options for a moment. Options on VIX are probably the most convex thing that exists in the marketplace, because VIX itself is convex, and then the options inherently have convexity. So when you layer convexity on top of convexity, they are just wildly convex. I would say that for 90% of everyone out there that doesn't know what they're doing, VIX options should be off limits until they really, really, really research them. Because what
can I stop you for a second? Because I know a lot of us are super technical people, but can you make like a 2-sentence definition of what convexity really is?
Oh,
so
yeah.
People understand.
So convexity, essentially you're looking at something that, for example, in a payoff curve, let's say you bought a very cheap option at 5 cents or 10 cents, the cheapest you could pick it up. The fact that it has convexity means that as the underlying goes in your favor, it's going, the profitability or the payoff for it is going to accelerate. It's not going to be linear. So it's going to be upward sloping and non-linear. So for example, your 5 cents is going to become 10 cents, and then 20, and then 40, then 80, then $1.60, and clear up into the $10 or $20 if you want. So to Itay's example, you could basically put on a very, very low cost position, and it could pay off in the tens of thousands of % gain because of the convexity that it has. That convexity, if it's upward sloping, is in your favor if you're long it. If it's downward sloping and you're long it, it's actually really not a very good thing for you. So you really kind of need to know, if you've got convexity, what's your exposure to that convexity. So the reason I say that options on VIX are a little bit sketchy. A lot of people that come into trading options on VIX think that options are actually based on the spot VIX price, and they're actually not. But they're also not options on the VIX futures. So options and VIX kind of float out in this gray area where they most resemble being options on the VIX futures, but technically they're not options on the VIX futures. Also, they're the only options I'm aware of in the world that can have a negative intrinsic value, which is a very, very strange thing. So for example, if you own a call option on VIX at, say, $35 strike, and VIX is currently priced at 70, you would think that you have $35 of intrinsic value, and that call option is going to be worth more than $35, and it's not. It's going to be worth less than $35, and that's very, very frustrating to someone who doesn't know the intricacies of VIX options. So most commonly people get into ETFs, ETNs, or inverse ETFs like Itay was talking about. A couple of those should have been uninvented and recently were uninvented. So Credit Suisse delisted their products because they had severe flaws. And TVIX going offline recently was the last manifestation of a product that was about to ruin an organization. If you look at March 18th, I believe it was this year, Credit Suisse had, in one single day on that, they had about a $6 or $7 billion unrealized loss on that ETN that there was no way they were going to be able to cover. They got lucky. The market reversed. They didn't have to cover that exposure. Had it kept going, they might have had more loss in that single instrument than the entire market cap of their company. So it was good of them to delist it. And now we're getting into a situation where most of the VIX products are actually ETFs. And then you've got options on futures, just for example, options on the underlying futures themselves, options on E-mini contracts. And that's where we're going to talk about convexity, for example. So how would you use volatility? Knowing that it has convexity is a very, very useful thing. And a lot of people jump into VIX thinking, oh, VIX has convexity, therefore it's going to make a fantastic hedge against my underlying stock portfolio. In actuality, that's not, as a blanket statement, that's not actually correct. So there's a few different ways to trade volatility. One is selling volatility, which, by the way, is statistically is one of the most consistently winning trades out there, and is positive expectancy if you can avoid getting blown up. So we'll talk about that in a moment too. But nonetheless, Itay made the comment that, you know, selling some, or either buying the inverse ETFs or selling some of the ETFs, ETNs is one of the biggest alpha generators out there. And in fact, it is, as long as you can avoid the blow up. The next one is that I would speak to is crisis alpha, which is basically saying, I'm going to use convexity to its fullest. I'm going to put an insurance product on that's very cheap. And as the market moves down, let's say the S&P loses 5% and my insurance really isn't going to pay anything because it's meant to be a catastrophe product. And by the time the market loses 10%, maybe I'm up about, maybe I've doubled my initial principal on that trade. But by the time the market gets to be in a 20% correction within my time frame, let's say that my very cheap insurance policy has now returned something like 2,000%. Okay, that's convexity at work. It starts off not going in your favor at all, and then once it picks up steam, it really starts to accelerate. That's typical crisis alpha, to say I want something very cheap that's going to protect my portfolio for a very small capital allocation. And then right in the middle of it, you would say there's volatility arbitrage. So you've got anything from buying and selling straddles of options to stat arb across the VIX curve, along the VIX curve, or the more common one that's popped up all throughout the markets now is people who arbitrage relative and implied volatility against each other. So for example, the easiest version of this is going through and saying, long, long, or short, short. I want to be long the S&P and long VIX futures, or short the S&P and short VIX futures, okay? Because that basically recognizes that under most conditions, there's about a 4 to 10% spread between implied and realized volatility. Almost always implied volatility is overpriced, and realized volatility doesn't materialize the way the market thinks it's going to, especially in those cases that we spoke about where there's some type of known unknowable out there. So you'll look through, if you ever look through a chart comparison between implied and realized volatility, you would realize that most of the time when VIX is priced in very high volatility, the actual realized didn't even come close to it.
That's right.
So one other thing to recognize in using VIX as a gauge of kind of what's going on in the market, we kind of discussed that VIX is a 30-day forward. So basically it's saying, what does the market expect the volatility for the next 30 days to be? And then they annualize that number. So for example, by that definition, VIX at 30, where it currently is saying there's a 1 standard deviation move expected in the market of plus or minus 30%. It's actually not very representative of what VIX actually is. The more representative is the daily representation of volatility by the VIX. So it's not even monthly, even though it's kind of represented on a 30-day forward. So if you look at it and you say, VIX is pricing at, for example, 30, what that means is that there is a 1 standard deviation daily move in the roughly 2% range. Okay. If VIX is at, for example, 80, like it was back in March, then average days are going to be something to the effect of 5% up or down. And that's exactly what we were seeing. So I would say if you're going to use VIX, get out of the mindset of using it on a monthly or yearly projection of volatility and say, tomorrow VIX is telling me that this is what the expected daily range is going to be. And if anybody wants to actually do the calculation, basically just take the square root of the number of trading days in a year and divide the VIX value by that number. And it will tell you what the daily fluctuation is expected to be. So
is that 252 days?
252 days, which comes out to be just a hair under 16 is the number there. So take the VIX number and divide it by 15.87, I think is the number. And that's the daily expected volatility.
'Cause I know when I was listening a lot to CNBC in the middle of the day, and there's a lot of guys that trade various things, and I remember them saying when the VIX was somewhere in the high 20s, that basically they were looking at a 2% daily volatile move on the underlying market, or on the stock market.
High 20s to low 30s, that's roughly what it is. Now keep this, the reason this is so useful is that when you look back to the 1987 crash, if we back calculate what VIX was in 1987, we realize that it went above 150. Now, if you look at it from an annual perspective, what you're basically saying is that the market was pricing in plus and minus 150% return for the market after that 20% sell-off. And that's not at all true. It wasn't pricing in 150% return or 150% loss, which is impossible. What it was pricing in was a 10% daily volatility, which makes a lot more sense. So that's the way to look at VIX. Now, let's talk about convexity in general. Convexity, interestingly enough, to use a convex instrument to protect against a portfolio, you have to say, are VIX futures, for example, a good protection against, for example, a 40% sell-off in the market? And the answer to that is actually not really. And also, is a long VIX position a good protection against a 2 to 5% sell-off in the underlying market? And the answer again is not really. So what it turns out to be is that VIX is very good at hedging against single standard deviation moves down in a stock portfolio. If you want crisis alpha, you need something that's more convex than VIX futures. You need something like far out of the money put options. And if you want protection against something like a 2% sell-off in the market, then you need to be constructing some type of options position that collects you the volatility risk premium, which is something like selling covered calls or doing something like that. But VIX futures really shine when you're talking about a market sell-off between, say, 7% and 20%. That's when VIX futures come in and provide a huge amount of value. So basically the thrust for us is, if you want convexity, buy it where it's cheap, and where it's cheap is with far out of the money options. If you want some convexity for the middle range, then actually VIX futures are far less expensive than consistently buying options to protect yourself against a 15 to 20% drop in the market. So if I could reference back to one of Itay's other slides, he pulled up the curve in 2017, in late 2017. And that's an interesting case, actually, because most of the time you would say, for example, that buying volatility is an expensive trade over time. You're going to be getting that negative roll yield. 2017, late 2017 was an interesting case of that not being true. As we got through November and December, it was one of the few situations in my VIX trading history that you could actually buy outright volatility and there was almost no downside to it. Within months, you were almost guaranteed to get a payoff. And that's exactly what we saw in February 2018. The question was just, what was the catalyst going to be? And so you were looking at, for example, being able to buy a VIX future that was two or 3 months back into the curve for sub $14 is an absurdly cheap price. Even for VIX at 10 or lower, $14 with 3 months left is absurdly cheap. So you could basically just buy that and wait, which is what we were doing at the time. And a lot of people were doing that. So the question is, why does that actually happen? Well, pretty much for the same reason that any other dislocation happens, like the one with SoftBank. You come in and you say, if the ETNs are getting very, very popular, for example, and they're putting significant downward pressure across the entire VIX complex, or if covered calls and iron condor strategies are becoming huge part of the equity market, they'll put significant downward pressure on the VIX complex. And eventually it'll become so low priced that it makes no sense to do anything but just buy the VIX. And you get that convexity trade. So
it's actually, you're 100% right. I mean, the whole reason for that 2017 was the SVXY and XIV being ridiculously popular and nobody buying them having any idea how they even work. I remember talking to some people that owned XIV, including one very large client at UBS, that he had about $8 million of XIV and he didn't fully understand contango.
Yeah. And so You're looking at that and you're saying they should be used strategically, but when people are piling into them, they are going to warp the market. Keep in mind on VIX, one point I'd make before we get to this slide I've got up there. Keep in mind that if you see correlation with VIX, the only time you're going to see, like we've seen recently, where VIX is skyrocketing and the S&P is skyrocketing at the same time, all of the buying is happening on the call side in that scenario. So you know for a fact that someone is bidding up huge amounts of premium in calls. And it's not a bad scenario to start jumping into that situation and selling calls like crazy. So on the other hand, if VIX is skyrocketing and the market's falling, what you're typically seeing is a whole bunch of put buying in that regard. So most of the focus is on the puts. And if VIX is falling and the market's falling, it's an unwinding of the call trade. That's the only explanation for it mathematically.
And we saw that today.
We've seen that the last couple of days. So for example, the amount of sell-off in the market for the last 2 days, especially with the repricing of spot VIX for the long weekend, you should have seen spot VIX higher by about $7 today with the amount of sell-off there was. And instead it printed 80 cents higher, right? And that's the unwinding of this call trade we've been talking about. So here's the fun thing right here. Looking at these distributions. Now on the left side, we've got all different types of VIX curves. Now we said most of the time VIX is in some type of shallow contango. Sometimes it goes into a really steep contango where the back end of the curve is, for example, in the 18s, but the front end is clear down in the 12s. Okay, that's quite steep. It can be flat, which is typical of where we would normally be now at about a 30 VIX or a 28 VIX. Or it can go into backwardation or steep backwardation like we saw in March this year. Now you can actually take VIX and construct really interesting payoffs with this. And if you look at some of this here, you'll notice that we have a lot of what we would call lopsided smile curves, where you put the position on, and if VIX goes a little bit higher, you might dip down into the negative momentarily. But if VIX keeps going dramatically higher, you go relatively parabolic on your payoff. And that's the convexity kicking in your favor. On the other hand, you can construct the exact same trade so that if VIX stays low or moves lower, you get a modest but still reasonable return on your investment. These are things that are possible to do within the VIX structure and the option structure that aren't really possible any other way. So it's really nice to say that I've got a very controlled payoff where Itay talks about collecting that volatility risk premium by selling volatility. If you can do it in a way that when VIX blows up, you've got high convexity to that side, so you have a parabolic gain, then that's arguably the best trade you're ever going to find with the most alpha generation in the entire marketplace. And there's several ways to do that within the VIX curve. Any questions? Because I know we're getting pretty late on time here.
So yeah, I mean, my version of doing it, just so I know we're late on time, so we'll do it a little bit. My version of doing it is just basically buying calls on the ETF to make it a 2-for-1 against my short position on the other side. Is there a better way of doing it?
The only problem with buying calls on the ETF is, one, you have to realize that VIX calls are incredibly pricey under a lot of conditions, and so you wouldn't want to come in, for example, and buy VIX calls when they're dramatically overpriced. The theta decay is going to just absolutely eat you alive.
Of course.
If you can do it by sticking completely to futures, for example, the nice thing is VIX is the only instrument out there where the futures themselves are actually convex. So you don't need the options to provide the convexity. You can actually ratio spread your futures and add more convexity simply by adding more back month.
Interesting. So you'd go into the back end of the curve and you just use the leverage in the futures, and you'll just short more on the front end of the curve.
So you can short near the front and then just buy more. So let's say you were normally going to short the second month and long the third in symmetry. Mm-hmm. You might go through and short 3 of the second month and long 4 or 5 of the third. Right? Now, getting the ratio correct is a mathematical endeavor, but if you can do that, these are the types of trades you create.
Super interesting. All right, and any questions from anybody? That was a pretty intense.
So last thing I would say is I'll give you one little golden nugget that we don't spread around that much, but since we're all friends here, I'll give it to you. This curve right here, if you ever see it, the market's going to crash within about 60 to 90 days. So, and I can explain why if anybody's interested, but we're a little short on time. So
is everybody going to be now on VixCentral.com every single day?
What line
We're
is
already
it now?
there.
Yeah, what line is it now out of all these?
it's incredibly strange, but it's actually, it's this one right now, except for the front month.
Yeah, that's true. The front month is in contango.
And it's the first time I can remember in the history of all my VIX trading that the curve is in backwardation, but the front month is in contango and spot is below the line.
And what does that mean?
I've never seen that either.
It means that in October and November specifically, we already had an expected October volatility period, and there's been a massive amount of call buying that has basically created an unrelated but perfect storm.
Oh,
so you won't
sound good.
You won't generally see that formation again unless stars align perfectly again. Sorry, I just realized that I was unplugged on my battery there, but
No worries.
So the reason when I talk about that linear contango line, what we're talking about is a situation where a lot of institutions out there are they're choosing to forego the budget that they allot toward buying medium-term protection. So think about it along the 2, 3, 4 month timeline. So picture these massive equity funds out there that run $10, $20 billion, right? And they're long only equity funds. They don't have a choice but to be long only. They typically have an allotment of capital to buy insurance, which is typically scheduled put buying. They roll them on a calendar basis. They come through and say, let's say they're willing to give up 2 to 3%, so 200 or 300 basis points against their returns to buy that insurance. They won't necessarily pile all that insurance into the very front month. In fact, they really like to get something like, the quarterly options or the 6-month options, something like that. Every once in a while, institutions unwittingly align their own interests with each other, and they stop buying medium-term insurance in favor of buying a whole bunch of short-term insurance. So what that does is it elevates the front end of the VIX curve and depresses the middle section and turns the curve linear. Now think about what that means to you as an investor. What it means is that all of the institutions out there have the same mindset, that they're willing to give up their medium-term protection in order to buy a whole bunch of short-term protection, which means that they're not selling the market right now. They're preparing for everyone else to start to sell it, and they're not going to be dip buyers when it happens. So all you need is the catalyst. If you want examples of when this has happened, February of this year, the curve went linear. January of 2018 it happened. September of 2018 it happened. Okay, so basically all you're looking for there is a catalyst. You own volatility, wait for the catalyst. As soon as the catalyst goes, the market's going to dump 15 to 20% on average within 60 days.
That makes a lot of sense.
All right.
That was super interesting. I really appreciate you sharing that.
No problem. Any other questions, or I think we're probably
tapped out. Okay. Well, I think you've done
speeches, man. That's insane.
Yeah. Well, I think you've done an awesome job, and we want to say thank you so much for being here. So we'll let you bounce out if you need to, because you've done a great job. So thank you.
Yeah,
Thanks. That was awesome. Appreciate it.
Yep.
One question.
Thank you so much.
Do you guys like have a website, Twitter feed? I mean, what do you all do on your own? Tell us a little bit about what your fund does again. Promote yourself for 5 seconds.
Okay, I'll talk about us momentarily. So our company name is Certeza Asset Management. Certeza is an ironical name. It actually means certainty in various Latin languages. And the ironical part is that we're all statisticians here, so we know that there's no such thing as statistical certainty. But it's the carrot that dangles out in front of us and says, can we ever get to that certainty point? We do VIX statistical arbitrage in our main private products. So we have a pooled fund, and then we have managed accounts. They do have relatively high minimums because we're mostly institutional. Although, as I mentioned, the one thing we're most excited about right now is actually bringing our first mutual fund online. We've wanted to have a kind of more of a publicly accessible product for quite some time now. So what we're creating with our mutual fund is essentially giving people exposure to the S&P 500, but layering the convexity into it, the downside convexity into it as is appropriate. For example, using VIX futures in the meaty part of the downside, and then using options for the tail risk and for the small consistent gains. And so basically what we're aiming to provide with that is a core allocation product where you would say, I can come into my portfolio and say, otherwise I would be allocating to spiders or something like that, or the Qs, something to get equity exposure. But this is going to effectively the target is to give a beta of 1 or higher on the upside with significant downside protection to give something like less than half of the downside exposure. So using convexity the way that we know how.
And if some of the people here wanted to get involved in that, what type of, when is this product going to be live? How much do they have to invest as a minimum? How could they get involved?
So we expect to take it live the end of this year. We're looking at what, Jim, is it November, December?
Yeah, around December.
Yeah, so around December it'll go live, and we'll have two investor share classes. One will be institutional for those who have $1 million minimum to go in. They get a slightly smaller fee, but otherwise the A-class shares are no load shares by design, and so we will be bringing. It'll have a slightly higher fixed fee each year, but the minimum investment is $2,500. $2,500, and then additional investments like in the $100 range. So.
Yeah.
So anybody can buy it through their Charles Schwab account basically and get exposure to the S&P with very small dollar amounts, but at the same time also have downside protection. Because what kind of burn do you have on your carry for that product? What kind of annual premium you would spend on protection?
That's the interesting thing. So what you have to realize about VIX specifically is that the way that we analyze VIX to protect against the kind of the meaty part of the drawdown curve, we can actually do that at either break even or a small profit. That's the nice thing about VIX, is that it has structural inefficiencies that allow us not to actually burn for that section. Now, to protect against something like a 0 to 4% sell-off in the market, we're actually selling volatility risk premium for that. So there's no burn there because that's actually an alpha generating trade. Right? Does everyone know what I mean by selling volatility risk premium? So, yes. For example, selling a simple version of that is selling a covered call is selling the VRP. Okay, so you're giving up potential really big upside in favor of capturing the volatility risk premium and kind of limiting your upside. And then, so the burn that we have is actually we do have some options that are long that are further out of the money to the downside on the put side, and those are exactly catastrophe insurance in this sense. They're not meant to do anything except for make sure that you don't lose 50% in a massive sell-off, right? And so when we come in and we use that, we say, is there burn? Yes, but the idea is to get a greater than 1 unit of downside protection for the amount of cost of the insurance. And we can do that with a combination of VIX and options. So a lot of things that people run into that's very difficult is they come to us and they say, okay, we like your VIX product, but we don't exactly know how to position it within our equity portfolio. We don't know. It's an absolute return program, so it's not really crisis alpha. It's not like you're going to layer our VIX product in over your equities and it's going to hedge you against a loss. And we might actually be correlated sometimes. And so we realized this, and we also realized that most people don't know how to take their equity portfolio and add the convexity in the shape that it needs to be added in. And so we said, you know what, that's a good mutual fund. Let's go ahead and do the work for people so that they can have their core equity exposure and have the convexity that they need. So without the guesswork and without the calculations, we've done all the calculations, so we don't have to wonder about it.
Yeah, that makes total sense.
Cool. Well, it's great. Well, you know, Brett, I'd love to be able to send out some information about this to everybody. I think you're building a pretty impressive product that people need to know about.
Yep. And you'll be able to find out. We'll send these guys the website link, and you'll be able to get it. We'll get on. We're aiming to get on the different platforms like Schwab and Fidelity and those as quickly as possible. But admittedly, right out of the gate, we won't be. So the best way to get it would just be to come directly through us and just invest directly into the product.
So an easy thing too, you know, for our RIA that we have it, if we wanted to invest, we're interactive brokers, but we can talk about it later. This is definitely something I'm interested in.
And so you want cash and small bills, or how does that work in Utah?
We want non-sequential 50s, I think is our preferred denomination.
Exactly.
Can I pay you in devalued VIX futures post contango?
So, no, but I hope you found it interesting. I could talk about convexity and the proper use of convexity for days. So.
Well, we know
Awesome,
you can.
guys.
Well, thank you guys so much for coming on. We really appreciate it. This is the point where we'll let everybody go, and we just hang out for the next 10 or 15 minutes, talk about anything and everything. Brett, don't feel like you have to stay on. You've done your job. You did great. Everybody's happy.
Great. Thank you.
Thank you.
Thank you, man. That was amazing, guys.
Being in touch.
Thank you.
Thanks. That was awesome.
Yeah, it was great. Thanks, guys.
Awesome, guys. Thank you.
So Itay, we found somebody that can finally challenge your intelligence.
Yeah. See, wow, that's like a serious chops, man. I'm a mathematician, and wow, it's like, I mean, that modeling is non-trivial, man. It's really insane.
He's he really knows his stuff. That's for sure.
Yeah, sometimes it's great to talk to people that you feel like you can talk and learn something from. I love that.
Well, and I think one of the things, it's a lesson to all of us, is they found their lane. You know, they found what they enjoy, what they're good at, and they spent a lot of time being an expert, basically at one thing. It's not like they're trying to do the whole world, as they said. You know, they've got one thing that they focused on that looks like it's paying off for them, and it seems like they do it well. And I think that's a really good lesson. Because you just can't do everything. You can't do every kind. I mean, you know, you listen to the kind of presentations. We had a guy doing fintech, and we have, we had another CTA. Then Itay has the stuff he talks about, and you're all in real estate. I mean, it's very hard as one guy to do it all, but it looks like they focused on something and used their gifts and abilities to produce something that's very productive and profitable.
Well, there's definitely value too in being able to figure out who those great people are and let them do their thing. You know.
Hey, the info on SoftBank doing all those trades, is that like kind of known on the street, or what's the deal?
So yeah, it was kind of known on the street, and I noticed something was off when I saw the correlation with VIX and S&P breaking apart about a week and a half ago, because I was short volatility also through one of the products we use, and I've noticed that, hey, the market's going up and I'm losing money and I'm short volatility, what's going on? And then I started realizing, okay, the correlation's inversing, we got to realize what's happening. And then it was reported on some financial blogs about a week and change ago, and then Financial Times confirmed that story later on. That actually came out way after the rumors were already fully out.
Oh yeah. Everybody knows what it is before anybody reports on it. Bloomberg had a piece on that the vol was off too.
Yeah, it was super weird. There was one day, it was when I was in Mexico, so I think it's almost a week and a half ago, and I'm looking, and VIX futures were up 15% on some random 0.2% up S&P day.
Makes no sense.
No sense at all. I think it was the biggest VIX future movement per S&P day ever. like up. It was literally like a non-event, like 0.2% up day.
So is the trade like buy X amount of options in size, and then also go buy the underlying, and then sell the options and keep the underlying in profit?
Well, you need to have very large ability to do that. I mean, see the thing.
But 8 billion is chump change for like big guys, right? Like I'm
Well,
surprised.
but when you're buying Apple with a market cap of $2 trillion, it's a drop in the bucket. You're not going to be able to move the stock, and you need to be doing it on something really liquid. So the way it works is that their $4 billion of purchase actually created a much bigger chain reaction for market makers, because so the way it works, if you buy an option that's far out of the money, the delta that the market makers need to have in order to hedge that initially is very low, because a 10 delta has essentially a 10% chance of expiring in the money, right? So
Yep.
they would basically just hedge it with 10% of the value that they need versus a full delta of the underlying. And as the market goes up, because there's a squeeze, they need to buy more and more and more because their delta keeps growing. So it's dynamic hedging that they keep doing every single day. And it ends up in a, in this situation that a $4 billion purchase can potentially trigger $200 billion worth of hedging. It's totally possible. Depends how far the options are.
Yeah. So what I'm trying to struggling to understand is like SoftBank is it known as the sharpest tools in the shed? So how come they figured
not at all.
else?
That's not even close. That's why it's such a random thing.
I mean, it's more like liken it more like the Robin Hood.
Yeah, they acted like a day trader that has no idea what they're doing, and somehow got insanely lucky because they were big enough to trigger that squeeze, where a retail investor buying 2 contracts is just not big enough to do that.
Oh, so you're saying, okay, I get it now. So they got lucky on the gains. It's not like that was their strategy.
No, not at all. That's what I'm saying. It's like they went to Vegas and put $4 billion on Black 13, and it just ended up happening.
No, that was their strategy, and they were lucky.
I mean, it was their strategy, but I don't think they knew they're going to trigger a gamma squeeze. I don't think that they even fully understood what that means.
So what have been so real quick, did anything that they did along the way, was any of it illegal?
It's not illegal.
It's not illegal. Okay. What would have been the implications for them if it didn't play out?
Oh, and another WeWork?
Yeah. Right. No, I mean, it's definitely, it just seems to me, it's just like, all right, your core business is shot. You're taking like big risks. I would be sitting here saying, I wouldn't want to touch SoftBank at all.
And I think this is why their stock was down heavily in the last day or so, when people realized that they're completely, even though they made a lot of money, I mean, what kind of risk management is that? They're just out of their minds. They're
supposed to be like a venture public equity or private equity fund, and they're definitely not acting like it. Gamblers. Larry's right. They're gambling.
Was there information on like the options that they purchased? Like at what was were they way out of the money, at the money, where like at what part were they?
So if you go back to, no, because so they filed the 13F filing. So if you have the Bloomberg terminal, you can look it up, 13F. If you don't, you can still go to the SEC's website, Edgar, and look up their holdings. So everybody that has over certain AUM, I think 150 million now, has to report their holding on a 13F filing. And you can see what calls they bought on which companies, but you're not going to be able to see the strikes and maturities. So you can actually see like, they bought $1 billion worth of Amazon calls, like it's there, and it was purchased sometime in the quarter before June 30th ended. So they bought it after the COVID crash. There was definitely an upside bet after the market's gone down quite a bit on COVID.
Got it. So how much do you think we could expect the market to keep falling, knowing that this position is now becoming unwound, and that they were a big part of the reason?
Well, there was this massive melt up. We don't know. Well, there's 2 parts. First, the initial move from COVID was all Fed. There was nothing else. Like we talked about that extensively. We saw the flows. We compared it. Then the speculation and the Robin Hood got triggered. Then the SoftBank, whatever. So the market just needs to find a new equilibrium level. But the problem is you know, if the market starts pricing fundamentals again and actually corrects, the Fed's just going to step up again as they normally do and put in a floor. So the question is not whether or not there's a Fed put, because there always is. The question is more or less, what strike is it?
It pays to be young. Sequence of returns risk.
Yeah. I want to know what Jay Powell is thinking. If you know that, you can print money all day long.
Print me some extra dollars.
Just give them your bank account next time they do a QE. Tell them they can throw a rounding error in your direction.
I didn't even get any of that direct deposit stuff. You know, I didn't get any PPP or anything like that.
We feel like we got scammed, right?
So it's all right, man. We will find ways to make our money. I'm not concerned.